So let's come to working capital management, and we are looking at this particular question. You can download the question under this video on the portal. So question number 3, plot code under working capital management. Remember, as per the syllabus breakdown, working capital management is a 15 marks area that we need to be mindful of. Done deal waiting for us. So when it comes to working capital, working capital is current asset, okay, minus current liabilities. And so you know from KG2 that the current assets are made up of two things, a number of things: inventory, trade receivables, cash, and trade payable, prepaid expenses. Okay? But for the purpose of our discussion, we need to know how to deal with inventory management, know how to deal with trade receivable management, know how to deal with cash management. Then you come under current liability. Under current liabilities also, we're going to have trade payables, okay? Certainly bank overdraft and other things. But we're going to be excited more on trade payables. So component-wise, under this topic, we're going to be focusing on inventory management, trade receivable management, cash management, and then trade payables management. Now, the key question we ask ourselves is, what are the objectives of working capital management? Broadly, there are two objectives of working capital management. It's to achieve liquidity and also increase the profitability of the entity. That is what you must understand when we talk about the objectives. Liquidity, meaning we have enough cash available, profitability, increasing our profit, and then maximizing the wealth of our shareholders. That's a two broad objective. I'll come back to these, so let's just go straight up into the question, and I need you to stay with me carefully here as we build this calculation into our story. Required. Calculate the following values for P, for product P. The total cost of the current ordering policy, total cost of the current ordering policy. It means you are calculating the inventory cost. And if you're a good student, inventory cost or total cost of the inventory will be your ordering cost plus your holding cost plus the purchases cost. Those are the three things adding up to inventory cost. The ordering cost is the cost you are incurring per order. Holding cost is the cost we are incurring for storing or keeping the inventories. Purchasing cost is the actual money you are paying for the inventories. So let's read the story for product P. Stay with me carefully. It says, Plot Co sells both product P and product Q, with sales of both products occurring evenly throughout the year. Product P. The annual demand for product P is 3,000 units. Stay with me carefully. Annual demand is 3,000 units. And an order for new inventory is placed each month. Stay with me. So the ordering time is each month. That means for the year, there are 12 orders. It says each order costs $162 to place. Okay, so quickly, let's begin the journey. Plot Co. So the ordering cost will be 12 orders within the year, because they said each month, multiplied by $267. That is the cost per order. And that is 3204 per year. Okay. Let's continue. The cost of holding P in inventory is 10 cents per unit per year. So that's our holding cost. We'll come back to that. Buffer inventory equal to 40% of 1 month's sales is maintained. So the amount of inventory they maintain is 40% of 1 month's sales. So the question we ask ourselves is, what is the sales for every month? Then we get 40% of that, then we can get our holding cost. So monthly sales, which will be the same as the monthly order, will be the annual demand, 300,000 units, divided by the month in the year, 12. So each month, how many units do we order? That's 25,000 units. So 25,000 units. That is a monthly order. Then we are told that the buffer inventory, what they must keep at all times, is 25% of 1 month's sales. So 25% of each month's sales, which is 25,000 units. So my answer times 0.25, and that is 6250 units. So that is our buffer. Now you need your holding cost. Holding cost is going to be your average inventory plus the buffer times the cost for holding. So let's get our average inventory for the year, excluding the buffer. And that is going to be your annual inventory. So let's see. Cost of holding is 10. Okay. So the average inventory we keep is going to be the monthly divided by 2. And that's going to be 12,500 units. Yeah. That's the average inventory that we're going to have. So now, the average inventory including the buffer, will be the 12,500 units plus the buffer 6250 units. Hey, give me a sec for my arithmetics well here. Wait, the buffer is 40%. Okay. So I'm missing something. So the buffer is 40%, not 25%. So 40% on the 25,000. And that is 10,000 units, rather. So the average inventory, 12.5. So that the average inventory, including the buffer now, is going to be 10,000 units plus the 12,500 units. So that our average inventory for the year is now going to be 22,500 units. So this is the average inventory, including the buffer that we will be keeping. So Now, based on that, we can get our holding cost. So our holding cost is going to be 22,500 units times, they said cost per holding or cost of holding is 10 cents. That's $0.1. So we punch that out, 22,500 by 0.1, and that is 2250 per year. Now, per year, not per hair, Nhyira. Now, for product P, which is what we are working for, we don't have the cost of purchases. They didn't give us the purchases cost. So although our formula for inventory cost is ordering cost, holding cost, and the purchase cost, there is no purchase cost there. So in the context of this question, it means we will do holding and ordering, because that's what we have. So the total cost will be the holding, the ordering 3250 or 3204 plus the holding 2250. So plus 3204, and that is $5454. Okay, 5454. That is the idea about the total cost. So that is the I part of the question for the current ordering policy, that they order inventories once a month. We go to II. II says the total cost of ordering policy using economic order quantity. Okay. So the economic order quantity is the units that must be ordered in order to optimize the cost of the entity, the ordering cost of the entity. And so the formula for the economic order, so it means we have to calculate the economic order quantity, divide it by the normal annual demand so that we can get the demand for the year, and then we will go with the same approach. Then you will see what we are supposed to do. So permit me to bring the economic order quantity formula. So this is the economic order quantity formula. So this is the holding cost. This is the annual demand. The C is the ordering cost. The square root, the 2 is a constant. All right? So we need to calculate the economic order quantity for the second scenario. So the second scenario is the total cost at the EOQ, economic order quantity. So let's get the economic order quantity. It will be square root of 2 times the ordering cost, which was given to us to be 267 per order, multiplied by the annual demand, which is given in the question, annual demand 300,000. We divide that by the holding cost, which is 10 cents, 0.10. So we punch that out, and that will give us the economic order quantity. So if you have a good calculator, you have the square root fraction, 2 times 267 times 300,000 divided by 0.1. And that gives us an amount of maybe 40,000 units approximately. Okay, 40,000 units approximately. It is 40,023 units. Okay, 40,023. But we can run it to make it 40,000 units to work with. So if the economic order quantity is 40,000, then how many orders must we make every year? So number of orders per year. And that will be your annual demand, the D, over the EOQ, the economic order quantity. And our annual demand is 300. Economic order quantity, the 40,000. So what will be the number of orders we will make within a year? 300,000 divided by 40,000, and that is 7.5 orders. So now that we know we will make 7.5 orders, then the next thing we do is to calculate the ordering cost. So under the EOQ, our ordering cost would then be equal to 7.5 times the cost we incur per order. And the cost per order is 267. So 7.5 times 267, that is 2,000.5. So 2002.5. So we can do 2003 Ghana cedis. So that's our ordering cost. But we need to bring in the issue in respect of those other things we did. So we need our buffer inventory, we need our average inventories, the same ideas. So let's go and work it out. So first, let's get our buffer inventory. So the buffer inventory, okay, EOQ. So we wouldn't need any benchmark. Let me go straight. Give me a sec. Because the buffer inventory, we already have it. So let's just go with the average inventory now. Excluding the buffer. Will be the EOQ divided by 2. So EOQ divided by 2. So 40,000 divided by 2. And that's going to be 20,000 units. Okay, 20,000 units. Now, our buffer inventory is still 10,000. So we don't need any problem on that. So now average inventory, including the buffer, will be 20,000 plus the 10,000 buffer, and that becomes 30,000 units. So since we now have this, we can now calculate the holding cost. So the holding cost is going to be 30,000 units multiplied by the cost per holding, 0.1. So 30,000, 0.1, that's 3,000. So my total cost will be 3,000 plus the ordering costs, 2003. And that's going to be 5,003 per year. So in the economic order quantity, we will spend 5,000 per year for total cost of the inventory. If we go with our normal ordering, then our total cost will be 5,450. So in that case, it is better to do the economic order quantity. All right, so that every time we are ordering, you order 40,000 units. That way, you are going to order only 7.5 times in a year, as compared to ordering every month, okay? So that your ordering cost in that case becomes 12 times in a year, so that it goes up. So it is cheaper in the context of this scenario to order 40,000 units each order based on the economic order quantity. But that is the II part of the question. Let's continue. III. It says, the net cost or savings of introducing an ordering policy using the economic order quantity. I've already answered that question. So the calculation. So III, it says net cost. It will be a savings. Because if they change to the economic order, they will now spend just this. So let's see. Net savings from introducing the EOQ as a policy. So it will be our current total cost, which is the 5454 minus 5,003. 5454 minus 5,003. And that is 451. So when we shift from ordering every month to ordering only 7.5 times within the year and ordering at the economic order quantity 40,000 every time, it will save us 451 Ghana cedi per year. That is the idea about the A part of the question. And this is about management of inventories.